We will start. We will start in next 2 minutes. Please wait. Members are joining slowly. Good morning, everyone. Yes. Welcome to today's session, valuation process basics, do's and don'ts. As you know that as valuers, we are receiving a lot of notices from IBBI, and they're asking explanations about our valuations which we have provided. And we thought it is the right time to discuss all with our members when we are issuing any valuation report, what is the basic things we need to take into consideration, and at the same time, so what are the do's and don'ts, like which we are not under our category or our valuation, that we will discuss. And I invite Mr. Naveen Singal for today's session to discuss on engagement letter and valuation requirements under IT and FEMA, and forecast of gaps and cost of capital. And later again, I will discuss about IBC valuation report and other, and we will discuss the orders issued recently by IBBI. We'll discuss those things. Now I request Naveen Singal to formally start the session.
Good morning, everyone. Thanks, Subbarao ji. It's a pleasure to be here talking to all of you. And what I would like to say that I would like...
Vijay, can you stop the sharing, Vijay? Can you allow Naveen sir to share the screen?
Okay. So what I would really appreciate and like that let it be very, very participative session, because it's more we discuss and learn from each other's experience. I have attended many seminars, and generally speaking, I do not recall that in any seminar we are discussing about that when we get a forecast from our client, what kind of... Am I audible?
Yes, sir. You are audible, sir.
Okay. So what kind of challenges we faces, what things we need to take care. I know it cannot be defined, it cannot be made watertight that, okay, these are the things which are there in any forecast, but still there are number of, I would like to discuss a few things, common mistakes which I find in various forecasts. I'm sharing the screen, will go straight forward to a live case study, a current valuation which I'm going through, and couple of examples from old valuations. Okay. My screen is visible.
Yes, sir, it is visible, sir.
So typically we get the forecast from the clients, putting numbers like we are sitting in April month.
Sir, your voice is very low, sir. Your voice is low.
Okay, I would be a bit louder. Is
Yeah.
it okay now?
Yeah, it's okay, sir.
So I'm sure that this kind of worksheet we are all familiar that what are the provisional numbers till 31st March 23. What is the forecast for the next few years, and then we look at the terminal value, right?
Yes, sir.
Okay, so then we look at, what is the profit after tax, the capital expenditure, cost of capital, and so on, and then we work out our valuation. Now, how to read these numbers, how to look at these numbers? In this particular case, the client has given certain ratios. Let me first go through the ratios. And I would like to have comments. Anybody can jump in and can comment upon what are his or her observation coming from these ratios. Before that, I would just mention that in 24, the client is putting up a big capital expenditure. The total sale is 70 crore, the forecasted sale, and the capital expenditure is 46 crore. These numbers are in lakhs. So 4589 lakhs 46 crore. Coming to ratios, the client had been growing. So first of all, when we look at these ratios given by the client, you would see that there is no growth rate which is given. The projected growth rate, we can work out the projected growth rate very easily. If I put these numbers, okay, so 23, the sale is 43 CR, and then 70 CR, 104.16 CR, and the growth rates are 64.2, 48, 24, 10, 10, 10. That is, then it's taken for a couple of, for 4 years. 10% type of rate of growth. To you, is it normal, or do you find anything abnormal in this?
Yes, sir. Abnormal only.
Normal, right?
Abnormal. Abnormal.
And what is the abnormality?
The growth is growing at 64.2.
Yeah.
And, whether there is any justification, we don't know. And why the growth is going down year after year. In most of the cases, we find that always the first 3 years, when we take in 2020, 21, 22, 23 will be very good. After that, it will stabilize. When you take in 23, 23, 24, 25 will be very good. After that, it will stabilize. This is the case across India.
Right. So even in this case, we look at 24, there is a good growth, 25 growth, and then it getting stabilized.
Stabilized. I don't know. This has become a formula actually.
But sir, there has been a huge capex, so that could be the basis of this incremental sale and all that.
Right. Any other comment?
Sir, maybe see after 3 years the company stabilizes. Okay, then we can't see much growth after a few years. Any company, maybe that's why the growth is stabilizes.
Okay, right. So normally speaking, yes, the sales would be in the initial 2-3 years, it would be at a higher growth rate, and then it would stabilize. That is a normal trend in case of any working company. In startups, the growth rate could be for the next 5, 7, 8 years, 10 years. But an established company, it would be high growth rate in the initial phase, and then it will taper down. Like somebody said very rightly, in this case, there is big capex, which I mentioned in the beginning. So this capex is leading to the high growth rates to start with. Abnormally high, we can say in certain terms, 64%, 48%, 25%. And then looking at the capacity utilization, etc., it's coming 10%. This is to my mind, perfectly normal case. Having said that, I have seen many, I would say, valuation where, let us say, if the first year the number is 100, next year it's 125, 150, 165, 190, let us say 230, 270. And we look at growth rates. This is just a hypothetical case. That is the live case which I was sharing. The growth rate comes to something like this. I see number of projections like this. Anybody else face this kind of issue?
Yes, sir. We see in few cases like this also.
Right. So what's wrong in this case?
So there is no wrong. Okay, it is all estimation by the management depending upon their sales and revenues they are giving, because maybe it is a cyclic industry.
Perfect. If it's a cyclic industry, this kind of stuff could be there. Having said that, I can imagine next 2-3 years coming up numbers like this, but then this coming zigzag 10, 15, 20, 17. Normally my experience tells, once you go back to the company and ask why there is this kind of zigzag, they normalize the number. One. Secondly, number of companies, they project lower growth rate for the next 3-4 years, and then they project the higher rates. Usually it will be other way around. Immediate future, 3-4 years, it should be high growth rate, and then it should be normalized growth rate.
Perfect.
Please put yourself on mute.
Vijay, can you make it mute, Chirag? Chirag, can you be mute?
જવાનું 10,000 એટલે હું તમને પૂછીશ મારે હવે 2-3 મહિનામાં જવાનું થશે
Chirag?
Here, Rajiv Dhingra, please mute yourself.
Chirag?
Ma'am,
Can
I
you
was
put it
about to
mute?
answer, sir. Sir, this sort of scenario is possible. The one you are mentioning now, initially it will be having a low growth rate, and then over after 2-3 years it goes up. That could be because of the ramp up period also, when everything is getting normalized, like we see in the cases of infrastructure, toll plazas, etc. Initial period it's little low, then it when everything stabilizes, it's on kind of autopilot mode, and then it picks up.
See, certain industry specific, it could be. Normally, I would say the lower growth rate in the immediate future and high growth rate later on, it's projected, with due respect, it's projected by the sales team. They protect their targets, immediate targets. They make the forecast lower for immediate 2-3 years. And then for future years, they put the high growth rate.
But sir, one thing in that, once
Yeah.
you go into say 5-6 years operation, the base will be larger, no? On a larger base, how will you get a higher growth percent? Is the problem.
Exactly. That's why I'm saying in the initial phase, it could be higher, but later on, it will start going down. The growth rates in terms of percentage, after 3-4 years, 5 years, they will start getting normalized. And that's why even when we do the valuations, we take the terminal value are below GDP growth rate, right? Because we know that in future it would be stabilizing, and it would be, or it cannot be higher than the GDP growth rate, for example. So when we look at these forecasts, sale forecast, my first message is we start with top line. We look at these numbers, and if there are abnormal jig, initial year the growth rate is, how you would react to the client if you get the growth rate 5%, 10%, 20, 25, 30. Are these kinds of growth rates acceptable? Without any explanation. If there is a reason that it's a new startup, first it's going into one geography, two geographies, stabilizing there, and then expanding the geography wise or introducing new products, we can still, or we may still expect these kinds of growth rates. But normally it should be the other way around, right?
Naveen sir, one more thing. See, when the capex addition, no, and the capex addition and sales, when we ask a company actually how much because of this capex addition, okay, we take that amount as granted, so much of 45 crores or something. If you ask the company actually what is the sales it can, how much sales it can increase, then they will say because of the capex addition it will only increase some 25% or 20%, but the turnover will jump to 65% or 70%. Whether there will be increasing selling price, we do not know, because after all, it is the number of selling units into units may increase, but then whether the selling price also will increase. If we really calculate both, we find always that the projection is on the very high side actually.
Perfect. I fully agree with you. And when we look at these numbers, we challenge the basic assumptions, the basic numbers behind these projections. We may find certain gaps which we need to get closed. Now, you cannot teach the forecast to each and every one of your clients. Of course, one need to look at the materiality, and looking at the materiality of the item, one can take a call whether to get it corrected, or it's okay to, to let certain numbers be they imperfect instead of being perfect. Any comment on the, or any comments, like, would you agree with my comments? Okay, so moving on, I will go a little random. This is a case where I get a forecast from the company. I have put very, very selective data. Here it's a 6 month up to 30th June 23. This data is of an offshore company being run by Indian promoters. So till 31st December, we got the actuals, and after 31st December, we put what is the balance period. So this is a 6 month data, and then 12 month. Revenue, total expenses, profit, tax, depreciation, finance cost, and then we look at the change in working capital. Out of these few numbers, when we look at optically, do you raise any query, or some query come to your mind on some number? Forget these percentages. Okay, I remove that. It's a very small data. It's sometimes, optically when we look at, it's so difficult to find the trend, or the trend line, and looking at what is abnormal. But still there is something very, very abnormal to my mind in this data.
Tax percentage very high.
Profit has increased by 3 times in the case of at the 30th June 2024 as per projection.
Sorry, what are these 3 times?
3 times of profit has increased by 3 times.
Yes,
Column number 18. Yeah.
agreed. I fully agreed, like 26.
That is because turnover has increased, no?
No, in percentage wise, it's 20%, 27, 30. Rightly spotted that the profit is going up. You know, normally we say that it's a benefit of scale, but in this case, if we really look at, you know, the growth rate, this is a yearly like 32,000, 35. Here the growth rate is 3%, if I'm not mistaken. 3%, yeah. The other thing which I would like to point out here, when I looked at these numbers, the sale has grown 1100, right? 36489 versus 3536. In absolute, the number have increased 1126. And look at the working capital. It has increased 3 times. Sometimes when we look at working capital as percentage of sales, these kind of differences may not be visible immediately. But having said,
So what it means is that entire increase in working turnover has not been collected. Nothing is collected. Entire thing is lying in debtors rather.
that's right, either debtors or inventory or whatever. But optically, when we look at, or even business logic wise, if your sale is growing by 1100, would you let your working capital increase 3,400, 3 times of the sales increase? That kind of business in a way will never generate cash flows.
Sir, I'm really sorry, but how the that working capital increased by 3 times?
So these are again, like I said, forecasting errors. Somebody not paying attention. And if you analyze, if you have done whatever valuation, if you will go through those numbers little critically, you may find these kinds of gaps.
Sir, in this actually, if you compare 23 to 25, it is reasonable only. If you compare 24, 25, it is unreasonable because turnover has increased by 1,000 and then debtors have also increased by 1,000. Whereas if you compare with 23 to 25, turnover has doubled. So working capital requirement also has in a way doubled. That's okay.
Yes.
But these numbers are for 6 months. So if we take the double, 32,000.
Okay.
You know, for the sake of simplicity, I'm saying 32,000. This is the balance sheet of the company. Normally, we take debt equity ratio. We look at, you know, borrowings, and then we look at equity, right? For the purpose of calculation of cost of capital. Now, when I look at this case, I found something. I looked at it. I find something abnormal, and that abnormality is there is a borrowing of 2.2610, and company is projecting cash of 15,000. So whatever profit or cash inflows, it's put into cash and cash equivalent instead of looking at that, you know, we would repay the loans. Now, what is the consequence of this? We take that equity ratio, we reduce our cost of capital in a way while doing our valuations, and somehow we may tend to miss out that if there is so much cash sitting on the balance sheet, why the cost of capital should be, you know, in a weighted average cost, or we take lever, unlever, and arrive at the cost of capital. Instead of that, should we be taking 100% equity?
Sir, one point, I think it may be a long-term debt. That is why we are continuing, maybe it is for 5 years or 10 years. But if I see the bank loan, that has literally reduced.
Yeah, so that's right, like 1, and then it's just a nominal number of 25. Agreed. But do you think even if it's a long-term debt, it cannot be repaid?
There may be debentures.
There may be.
Debentures.
It may be a term loan. It may be a term loan for, as you have rightly mentioned about this capex. So it must be a term loan for 5 years or 7 years, something like this. That may be the reason it is continuing.
But term loan is to be paid in installments.
Yeah, term loan can also be repaid in advance if the cash is sitting idle on the balance sheet. Any investor, when we are looking from market participants' point of view, the valuation of the company, any investor will look at that, why there should be long-term borrowings, and the cost of capital should be taken only on the equity. A thought. I do not know what is the perfect answer, but my view on this would be, I would take in this case debt equity ratio 0. And this is not, I'm not continuing with the old example. This is of a 45 CR capex. This is a new, another company.
But normally we are told that if there's a capex because of additional capital, share capital infusion also, and when we are valuing the equity shares before that infusion, we don't take the capital and also this increase in capex. No? Then how is it relevant here?
Okay, so if you will look at the capital 36th June versus 23 versus 24 versus 25, it's the same. And in fact, even this 31st 12/20, this was an error in the numbers given, because capital cannot be 3622, then it reducing and then increasing back, right?
Yes, sir.
Okay, so 1 second. You made the question that there could be capex and that capex needs to be reckoned. Absolutely. And when maybe I went a little too fast. We look at, in this case, there is no capex, 0 capex. This is an old term loan. The company is accumulating the cash. In such cases where there is
Reserves and surplus reducing.
Yeah, because this is an error. This is a shift between the lines. Something from here, it has moved in a reserve and surplus. So that we got corrected, that we moved back from reserve and surplus to equity share capital. And then reserve and surplus were got, corrected. You're absolutely right. So coming back, if there is so much cash sitting on the balance sheet against a minuscule loan, the debt, one, forecast itself, secondly, debt equity ratio, the consequence I'm telling, one of the consequence, debt equity ratio. How many of us takes cost of capital on a yearly basis rather than one number for all the years?
Sir,
Why
can
would-
you repeat the question?
Cost of capital. There are 3 options that we can take in cost of capital. We can take the, normally it's like discussed, we can take 3 options. 1, we can take the target debt equity ratio. Second, we can take the present debt equity ratio. Third, we can take the yearly debt equity ratio. Right?
So, sir, in case we are having a debt schedule
And in case the company is going to repay the debt in a systematic manner, and if we are projecting the debt repayment and incorporating in our cash flow statement, then we used to take the per year debt equity ratio, find out the per year debt equity ratio, and then we will arrive at the cost of debt for each year.
For each year, right? And if it's a fairly similar kind of debt equity ratio, then you can pick up what seems to be most appropriate, whether it's present or a targeted debt equity ratio, right?
Yes, absolutely.
Excellent. Now, in such cases, I would go for debt equity ratio on a yearly basis. If there is so much variation between debt equity, if we look at 23 versus 25. One. Secondly, I would ignore in this case the debt. To me, it seems, of course, I will discuss with the management and ask them this long-term borrowings, should it not be repaid if you are having so much cash? And what would be the logic to keep these borrowings? If it makes sense, I can still take a debt equity ratio. If it does not make sense, I may remove that.
And sir, in long also, in the second year, there seems to be an error.
There was some specific reason. These are the actual numbers: 30th June 22, 31st December 22, and then these are the projections.
So there is some 500 inflow which has been repaid. It seems
Which have
like
been
that.
repaid later on. That's
later
right.
on in the 23. Okay.
That's right. That's right.
Okay. Thank you.
Okay. Ratios in the first example when we looked at. So here the company is projecting that, the actual current ratio is 1.24. It will keep on improving. And that is the way the business should be. Improvement over whatever is there presently. Similarly, when we look at, this ratio, it's increasing. Debt service ratio, net profit ratio, gross profit ratio. Anything wrong in this? The numbers which are appearing on the screen, the ratios, look at the ratios.
While gross profit ratio is reducing, net profit ratio is increasing.
Absolutely spot on. In this case, when we look at the gross profit ratio is not, apparently we can see that 25% kind of a ratio is not an abnormal ratio. And any business should be or would be protecting the margins. Why anybody should project or not project, I would say, why should we plan a business with reducing margins? We have seen that the growth rates in these years is 10%. It's not any abnormal growth rate where the person says, I am playing on the volumes and looking at increased, increased revenue, high growth rates, and taking a bit of hit on gross profit and improving my net profits. Net, I am, quite ahead in my cash flows. So 27%, 32 going down to 27, going down to 25. This kind of forecast needs to be challenged, understood. So even when we raise this question with the company, they change their forecast. How do I, one they have given, the second way we can do it very quickly. Direct cost. Obviously, if the gross margins are reducing, the direct costs are going up. And I do not see why, any reason why anybody should plan a business with reduced margins.
Sir, maybe because of the competition, one cannot raise the price on a yearly basis. But because of inflation, maybe the direct cost is increasing. I mean, the difference is not big enough that I will take it as a okay thing. Please correct me if I'm wrong.
I would differ. Like I said in the beginning, the gross margins in this case are not like 60, 70, 80, 90%. There are only 27, 28%. You know, if I look at here, 32%. I can imagine, you know, this is the high growth period. In this case, the company says, okay, we will be getting into some low margin products or lower margin products. My product mix is changing. If there is any valid reason like this, you know, can we plan like we do our practice? Can we plan our margins, or I can say our annual revenues on declining basis? No. We will not be projecting that, okay, so this year my gross like fees minus staff cost is 100. Next year it will be 90. Year after it will be 80.
Okay.
If we look at, you know, big companies from stock market, if we analyze blue chip companies, we say, or any other big companies, normally we will see only improvement in margins. And these companies, in spite of having very large base, still they are improving the margins or protecting the margins. It's worth asking if there is any valid reason why these numbers are declining, like product mix change, high growth rates, and company taking a conscious dip on the margins to improve the overall realizations. One can still imagine, or a competition expected, if these margins are 80%, and then put it later on 60%, 70%, still one can imagine that competition is kicking in, and they have projected or planned that there will be decline. But with 28% kind of margin, I don't think it's the right thing.
Okay. Right, sir.
Sir, can you adjust your camera? We cannot clearly see you. Yeah, now this is better.
It becomes difficult to see my screen for me.
Okay, as you feel convenient.
No, I will little bit tilted.
Naveen sir, one more check I used to do actually. One is that, you know, the current ratio and the net working capital. Okay, whether they are in tandem, whether suppose current ratio is increasing, whether the net working capital also increasing, or whether the current ratio is decreasing, net working capital also decreasing. If it is there is a mismatch, then there is some diversion.
Right.
So that also one of the check we can, because the screen I am not able to find out the net working capital.
I don't think it's given in this sheet. Net working capital current ratio is given, but net working capital is not given.
And one check will also tell whether the numbers are right or wrong.
True. And also, like, we need to look at the business reason. You know, these days, most of the companies, they look at, apart from top line and bottom line, they look at the cash flows. And companies are looking to, you know, reduce their working capital year on year. Even if there is an increase in sales, 5%, 10%, they look at how to, you know, reduce their working capital. And there are a number of companies where the working capital is negative. Well-established companies having working capital negative. So one should be conscious about, the numbers and the impact on the business, or what could go behind that business plan. Okay, so should I move on? We look at top line, we look at direct cost, administrative cost. I may skip for the time being, but let us look at these also. Oops, sorry. Let me freeze the panes. So we looked at it, sales is growing 10%, 5% number at the end, which you see it's a terminal value purpose. I put certain numbers. If a sale is growing at 10%, should administrative expenses be growing at 10%?
No, sir.
So what should be the number?
Because of the marketing cost.
It depends on what is the type of product that is being sold. If there are no more number of branches that are being opened, then maybe there will be more of admin costs.
Yeah, so okay, let me rephrase my question. If the sale is growing at 10%, administrative expenses should be growing higher than 10%, lower than 10%, equal to 10% as a business.
Less than 10%.
Less than 10%, right? That's where we say it's the benefit of scale.
Yes.
All of us talks about benefit of scale, but if our fixed cost keep on increasing at the pace of sales growth, how can be there benefit of scale? Selling and distribution expenses again. Now, if we look at here, top line is grown 64, selling and administrative by 14, 49, 49, 25%, and then here it's 56%. And I'm sharing is the live case. It's not, the numbers which have been just put, like I put in case of this worksheet, I put some random numbers. But obviously, like looking at the materiality overall, you may like to raise certain questions with the client, or you may like to ignore those. Sorry, somebody wanted to say something.
Sir, can you be a bit louder?
Okay, I thought I'm speaking. Is it okay now?
Yes, it's okay.
I'm not sure why I'm facing this issue today, but please do stop me if my voice is not audible. I will speak a bit louder. Okay, so generally speaking, like we said, fixed cost should be growing at a pace a bit slower than the overall top line growth. And these can be like, we can put certain formulas, some checks, and then looking at the materiality of the number, we may like to go back to the client, or we may like to take the numbers as it is. Make sense?
Yes, sir.
I'm not commenting on any further numbers for the time being. Okay, cost of capital, one of the topic I had on forecasting gaps, I had these things in my mind to share. If somebody has some any specific question on this, on general forecast, would be happy to take at this moment itself.
Selling and distribution expenses have reduced drastically over a period from around 59% to 10%.
Yeah. Okay, so this is what we discussed that, here the selling expenses has gone up drastically. And like you said, if we look at the percentages.
Generally, it may be a percentage of sales.
Yeah, I'm putting that also here right now. Okay, so 23, it's projected, or it's actual number 12%, 11.5, 24, 8, 25, 8, and then 10% of the sales. Usually speaking, selling and distribution cost, actually marketing costs, they are defined as percentage of sales, and most of the businesses would like to keep that percentage number stagnant, or would like to increase those expenses supported by higher sales revenue growth. Okay, and whereas the selling expenses as a percentage, they should go down. Now,
but if the competition increases, then naturally the manufacturer may have to offer a higher margin to the distributor.
so the margins are already taken care on in sales revenue. Sales revenues are net of margins.
Okay.
Selling distribution costs are your salespeople, salaries, your transportation, marketing expenses, you're running the advertisement, dealer boards, newspaper ads, etc. They will appear into, when we look at these heads, sellings and distribution will appear there. Now, the problem here is why these numbers are wrong. There is a heavy capital expenditure, exponential growth in sales, 64%, and then the selling and distribution cost, if we look at as percentage, they are declining. I do not have the absolute numbers here. What were the numbers in 23? But directionally speaking, if these numbers are 8% and then increasing to 10%, directionally these 8% numbers are wrong. It should be a bit higher number, until unless there is a valid reason for the same.
Sir, we can go a little fast considering the time factor.
Yeah, I would see. I would like. I consciously decided to spend a little more time on this, because engagement letter, etc. We still hear in certain seminars, but I do not remember having discussed the forecasting like this in any of the seminars. So I thought, let me spend a little more time here. Is it okay? Anyway, I will cover this.
Yeah, because it's already 8:20.
Don't worry, I will finish at 8:40.
Okay.
Okay. But good that you are reminding. Okay, before I discuss about engagement letter, I can briefly touch upon on cost of capital. One thing I already touched, or two things in this discussion already. Those are cost of capital on yearly basis, or targeted or current. One can take these depending upon looking at the forecast. Second, if we look at abnormalities, like there is a loan and then there is a heavy cash on the balance sheet, again, we need to discuss and take a call on debt equity ratios, whether, how we should be looking at that. Third, I would just like to mention, lot many valuations I see that there is WACC, weighted average cost of capital, without taking into account.
Hey, good, very खुश रहे. So ये अच्छे से. खुश रहे.
Is it a
Vidya, can you make me
Negative.
co-host? Vandana, can you please mute yourself?
Naveen ji, are you sharing your PPT or?
No. I will share. I'm just speaking about cost of capital.
Okay.
On cost of capital, I have not prepared any separate Excel sheet or PPT as such. Okay. So what I said that cost of capital, I will just recapture since there was some disturbance that cost of capital, debt equity ratio, it could be present, it could be targeted, or it could be yearly depending upon the circumstances, the forecast, the business. One can take, what makes most of the sense. Ideally speaking, yearly, my favorite is taking on yearly basis. The second,
I have a doubt here.
G.
In a technology company, especially these startups, where they do not believe in debt, okay, and when you have discussions and representation with the management, they're of the view that they do not go into debt model and they only want to go ahead with equity, different series of equities. Okay, can I just go in FCFE and then go for KE as a discount rate? Is that permitted? Is that okay?
You're saying taking only the cost of equity, right?
Yeah, KE will be the discount rate and
yeah, absolutely. If there is no debt,
FCFE instead of going FCFF.
Absolutely, one should go for FCE. If there is no debt, obviously we will go for FCE.
Yeah, debt is there, but then it is only by a director and it is short term.
Good
Just
that
a
you
fund
raised,
adjustment.
good you raised this. There might be some case that, as even in a normal private limited companies, that we look at, when we look at the balance sheet, let us say the capital is 5 lakh rupee, and then the loan from director is 50 crore, which is the interest-free loan. Even could be the interest-free loan of 50 CR. In such cases, one can, one will still go for the cost of equity, or will take the market rate of interest on the interest-free loan given by the directors.
Actually, if it is more, fine, but if it is nominal, say 5 lakhs, 10 lakhs, or 50 lakhs, or max to max 1 crore, okay. Whereas the turnover is at a different level. It's a, startup with 3 or 4 years of, experience. So in that case, in your case, I understand the debt was material, huge amount. But if it's not that material, then we can go ahead with FCFE and KE, right?
Absolutely.
Okay.
Absolutely.
Yeah.
I have a question in that. When you build the financial model, so for startups like this, so when you have the negative cash flow, and if you assume that you are going to raise the equity for each year whenever there is a negative cash flow, then do we have to make any adjustment? Because what we are doing is that currently we are raising for X amount, and for every year we are going to, or we are also going to raise some different amount also. So because we are building the model in such a way that we are assuming that we are raising the equity each and every year, then do we need to make some adjustment? What are those kind of adjustments that we need to make while arriving at the equity value for the current year?
Okay, so there could be, if I understand your question correctly, there could be two kind of adjustments. One, debt equity ratio. Second, it could be, if the question is whether we should take equity inflows into the discounted cash flow or not, right?
Yes.
Or anything else coming to your mind?
So basically, for the debt equity ratio, the first point is out because we are not assuming that there is any debt. Okay, only the equity is there. Okay, but what we are doing is that currently we are raising, for example, 1 CR, and next year onwards, every year we have a negative cash flow of 5 CR. Okay, then we are assuming that, okay, whatever would be the negative cash flow, I would raise it through the equity. So every year 5 CR, 5 CR, 5 CR we are going to raise. then how to adjust those kind of equity inflows?
So the short answer is no need to adjust for those equity inflows in the cash flow. And I'm sure you would be doing the same presently. Right? In cash flow, we will not be reflecting that inflow when we do this discounted cash flow. It's not possible for me to simulate right now on the Excel sheet here why I made this comment, but I think anybody doing differently on this?
Sir, not very clear. Can you just repeat it?
I said that the cash inflows on account of equity, which are projected in future, they are not considered in discounted cash flow.
Okay.
That is a short answer. If anybody is doing it differently, we can have a further discussion.
Sir, even I do that, but I have a query on this. Can we also consider it in the discounted cash flows? And that way it will be post-money valuation, no? So remove that the effect in the end, whatever the present value of those cash estimated cash inflow, we can remove it. Does anyone do that kind of practice?
Yes,
Like
yes, I do that. So basically what we generally do is that, for example, right now, the current valuation, what we are doing is for raising the equity inflow of 1 CR. And for each year, if we are projecting that there is a negative cash outflow, negative cash flow of 5 CR, then we are assuming that, okay, the company is not going to raise the debt of 5 CR, but they are going to raise the equity in each and every round. Then whatever would be the equity they are going to raise, we will discount it to the present value, and we will deduct it from the total equity value arrived using the FCFE model. And then we would arrive at the net present value for the current equity round.
So help me understand, what does it essentially mean? Whatever inflows are there of equity in future, discounted cash, discounted values, NPV is taken. That much is clear. After that, what you reduce from the overall valuation?
So for example, the first year I have raised 5 CR because that was then 5 CR I would take it discounted to the present value for the current year. Second year, if I would have raised 2.5 CR, then 2.5 CR I would also discount and take it to the present value of the current today's date. So and so forth, I would arrive at the present value of the whatever the equity inflow we are going to raise. And that we will deduct from the equity value so that we can arrive at the present value of the current equity round. Otherwise, sir, what happens that we are assuming that, okay, for the current equity round also, we are going to raise so much of equity in the next round, but we are not getting the number of equity share. Because, yeah.
Sorry, so that means like what you reduce is the discounted NPV of future equity?
Yes, yes, yes.
So essentially it means like on one hand you add and then you reduce. The other option which I said that just ignore it. So the result in both cases would be same.
even I agree with Mr. Naveen, like result thing is same.
Sir, I want the thing is, if we ignore it, then how is this additional cash flows being funded? I mean, it has to be funded through some manner. So ignoring it, had there not been this additional cash flows, then there would not be the resulting revenues. On one hand, we are considering the revenues, on the other hand, or the net cash flows, but we are not considering the source which is resulting from these cash flows. So how about the shortfalls, making an assumption that the shortfalls are being funded through debt, and we take for the debt, we take the market rate of debt. That's one way, market rate of debt. Going forward, when we are computing when we are considering the weighted average cost of capital, the weights for debt and equity, the debt equity ratio, either we take the market rate of debt equity ratio, or the future cash flows will consider the debt and equity balances on the future dates. compute the debt equity ratio for each of the years, come to an average, and that average use it as the weights for computing the weighted average cost of capital. In this way, what will happen is the additional funding, one, we will be considering the interest. Two, in the weights, it will have the debt will have a higher weightage, and accordingly arrive at the debt equity ratio and weighted average cost of capital. The other point is basically when we are taking the market rate of debt, market rate for the debts, what we are saying is, had this equity funding not happened, then the company would be in a position to raise the loans, and accordingly, had it been any other company, then this is how the funding would have happened at the market rate of debt. That's the assumption which can be taken, is what I feel.
Yeah, so basically we discussed that, looking at it, two things I would say. First, on cost of capital, like we discussed, it can be taken yearly targeted or yearly projected debt equity ratio. Absolutely zero issues in that. Here, the only question which we were discussing, whether to take in cash flows or not, in discounted cash flows or not. Obviously, in the company working, when they give the projections, the money coming through equity or debt, whatever projections are there, it would come. In the company cash flow projections, the issue being discussed, whether we take those in our DCF calculation and how. On that, the discussion was whether we take this equity through discounted cash flow or we do not take. The end result is the same. The end valuation is same. If we are missing anything from your question, then you may repeat. If you think it's answered, then I can skip quick and break down to engagement letter very quickly, 5 minutes.
Sir, I have one clarification in this.
G.
Sir, I think as we discussed and also other members, gap, we should not project a notional borrowings. Automatically it takes care. Another point is, I think other person was saying about interest calculation and other thing. See, these only timing differences. When you do DCF, and then we'll add back this interest cost post tax, add back, adjusted, and also the borrowing will adjust it. So net to net will become same only. We should not, whenever there is a shortfall in the cash, we should not assume borrowing ourselves as an equity. Otherwise, it will create what we calculate as a pre-money valuation. So pre-money valuation, I think it takes care, and we should not consider the additional funding as an equity, sir.
We should not be taking any assumption on our own. Obviously, the management will give the projection, future funding will come through equity, or it will come through debt, or it will be a mix of both.
Yeah, sure, sir.
Right?
Yes, sir.
Okay, so I will go through quickly engagement letter. I've got only 5 minutes, and then we'll hand over to Mr. Subbarao. I'm like engagement letter, I'm not talking about the importance, etc. I will just go quickly through the contents. It's addressed to the board of director or audit committee. If the company has got audit committee, then it should be to the audit committee, otherwise it to the board of directors. Section 247 of the Companies Act, board audit committee has the authority to appoint valuer or the board of directors in absence of audit committee. Fair valuation of.
Sir, in case any delegation is permitted, like so-and-so director or company secretary is authorized, to appoint registered valuers. They approve the, they approve whatever is relevant for this particular offer. And they also mention the so-and-so is authorized to appoint registered valuers. And that person is, it's not the board. That person is actually having the engagement with us. So do you think it's a proper delegation?
My response on this, yes, if the person is signing on behalf of the board of directors or on behalf of audit committee. I will not be addressing these to Ms. Shilpa Kiran, Fla company, and then ask you to sign. At the bottom where I put your signature, it's accepted and for and on behalf of audit committee or board of director of the company. And there, if you are having the authority through any board resolution, it can be signed off by you.
What happens if it is practice? It's not possible. Sorry.
Sorry?
Sir, what happens in case this engagement letter is signed off by a director, not not saying that okay, it is on behalf of the board, but it is signed off by a director.
On behalf of company, that's what Mr. Devashish is trying to say.
Yeah, exactly. So he signs as a director, so and so company.
It should be on behalf of the board of directors or audit committee.
But the directors will have assumed powers to act on behalf of the board, no?
If there is a resolution, then yes. If there is no resolution, no. If there are 5 directors, not all the 5 directors will have all the powers to run the company individually.
So this is the most impractical stuff. Most of the banks, when they give engagement letters, the respective department, the loan recovery department, collection department, when they want to do the valuations, they do it, and it's as part of the regular process. The vice president or the whosoever is responsible, they engage you, and especially if it's even a listed entity, it's even more difficult. Now you are not going to get saying that give me your board resolution, check me whether you're authorized, whether you're delegated. I mean, I think this is for a small private limited company, probably it works out. For large entities, this is highly impractical for a registered valuer to really ask for such details.
Sir, in my practical experience, sir, in even listed companies, big companies, we can get the valuation like engagement letter, director signature, or his authorized person. It is not a big thing, okay? Like even for big company, you can get it.
No, director signed, but asking that whether there is a board resolution and whether the director is authorized to sign on behalf of the board, I think very few companies will be really interested to.
I think in case of a listed company, they'll be more worried about corporate governance, so they'll definitely do it.
No, answer is something else. I think what is material is they may take internal caveats, but typically the department, the people with whom you work, you can. So normally the engagement starts in terms of the scope of work, capability, valuation, price, everything. Then once you issue a mandate letter with all that stuff, we do write that it is a presumption that the person on the other side signing is essentially the one delegated, because he is representing the company and he is signing as such and such designation on behalf of the respective company. Now here you cannot go back and say that please confirm that you are authorized or not authorized and all that stuff, otherwise I'll not take it up. I think that's a little I stopped asking all those questions.
Sir, in few cases, what is happening, okay, companies also appointing 2-3 valuers, and whichever valuation is good for them, they are going to use. I have seen practical experience. They appointed, okay, they have taken report from one valuer, another valuer, and which is whether, okay, for their expectation is good, they are taking. In that cases, it will be useful for us, okay, we need to get that board resolution.
What stops them to hire more than one valuer?
Yes.
Nothing stops, right? See, if a company says they have appointed Subbarao and they appointed Ganesh,
correct,
for the same purpose, doesn't matter. They can pick up one. That is their call. As far as Subbarao is concerned, when he's reporting, as far as Ganesh is concerned, when they're reporting, we are clear saying that there's a scope of mandate we written. In the mandate letter, we clearly mentioned that registered valuer appointed. The person who is appointing also is saying or signing on behalf of the company at a CFO level or at a designation representing the bank, especially or a company. You cannot go back. I mean, I'm not saying right or wrong. I'm saying it's literally impractical to go and say, okay, now you go and prove your point that you are authorized.
Sorry, as a capacity of valuer, we can practically you can go and check and we can get it, sir. There is not a big issue in that getting the board resolution.
No, small company vis-a-vis big company. There also small companies may not go for 2 valuers and they are ready to give board resolutions. They are ready to sign on behalf of board, but big companies, I have faced this problem.
Sir, this all will count, okay, when we receive any notice from IBPI or when any NCLT clarification receive all this matters, sir. Yes, maybe okay. If it not comes anything, if everything goes smooth, no issue in the appointment letter, in the engagement letter, in the management representation letter. Once it comes to NCLT or IBPA, is all thing matters.
So normally, therefore, what I do, Subbarao, is in the
Yes.
engagement letter, I do mention that this is appointed by the board or audit committee. I do mention that one liner in the engagement letter itself.
Yes.
So as a bona fide action, we have taken care of it. Now, other side bona fide action, we cannot control on that.
Okay, so if I may intervene here, the basic discussion here is we are all in agreement that the letter should be, the engagement letter should be signed on behalf of the board. Any disagreement on this?
No,
The
sir.
second, okay, so the second question which is raised is whether we should take the board resolution or not. Okay, so this board resolution, copy of the board resolution that the person is authorized taking that, my experience, theoretical answer, yes, if one should take, and if one can take, it's excellent. It should be taken, but my belief, 95%, if not 99%, valuers do not get the board resolution copy. That is my belief. With that, we can probably park this. We will not end or we will not get any perfect answer to this. The practice, the theoretical answer, get the board resolution. Practically, it's not available to the valuer.
If the person appointing the valuer certifies that the board has already passed in the resolution appointing him as a valuer, I think it will be enough.
Okay, so let us move on. Board of Director, engagement letter, your own identity, fair opinion on fair value of equity share, debenture, whatever is the instrument, as of this is the valuation date. In the scope of work, again, putting what we are going to value and the valuation standard according to which we are carrying out the valuation. The very brief that we will be taking these things, we will asking the questions, discuss the management plan, and then we will issue the final report subsequent to clearance of your comments. Confidentiality of the report, that it's confidential to the appointing authorities, statutory authorities, and cannot be circulated without our permission. CLDs which we put in our report, the general CLDs, caveats, limitations, and disclaimers, those should be attached as additional terms and conditions. Working paper, they will stay with us. This is putting a paragraph on working capital, professional fees. In the professional fees, we cover that if there is any legal counsel, lawyer, etc., or the scope of work increases, if to do extra work, then there would be extra fees to protect ourselves. When would we raise the advice, what would be the overpayment terms? If there is certain advance, we mention in the engagement letter advance, if the payment is coming after submission of the report and so on, that can be put. Limitation
So whether in this engagement letter you were mentioning about fees, you said something is not included and all, but as a CS, can I add that this so-and-so is the valuation fees, so-and-so is my CS fees? Is it permitted, first of all, that I take CS, considering that it is not a value add-on or it's not a retainership, it's not a consultancy, it's just one engagement of fund, whatever they are getting it. And filing is more like, you just file a form. There is no conflict of interest. Do you think I should desist from taking any CS assignment, which is more of filing and not in advisory role?
Look, I will, to my mind, if we, after the capital, etc. is raised and the company is getting the filing done, I'm not expert on the professional ethics, but I believe there is no conflict. My personal opinion, there is no conflict.
Madam,
provided it is not advisory and it is not on consultancy kind of a thing.
No, madam, the regulation, this section only says that you should not be secretarial auditor or a statutory auditor. That's it, no? Otherwise, it's permitted. That's as per the section now, no?
Sir, you can do CA related advisory role. Is it permitted? according to your
Yes,
view?
because what is prohibited is only you should not be statutory auditor, you should not be statutory secretary, company secretary. That means secretarial auditor rather. You should not be secretarial auditor. You should not be statutory auditor. I think that is the only restriction. Is it right or am I wrong?
I request all the participants to give their views, because many of us are also CA or CS or cost accountant, and we could be, offered more services. So whether it is permitted.
Shilpa, in my view also it is that, see, you are a company secretary, and whenever a funding happens, there is also a requirement to file all the NGT 14s, PAS 3s, SH4s and SH7s and all of those things. So in my view, I think there are two separate services. In the capacity of a registered valuer, you are issuing a valuation report. And in the capacity of a company secretary, you are certifying some of the forms. Maybe you would have certified an MGT 14.
Is there no conflict of interest as a valuer?
Where is it written? No, where is it written? Where is the conflict of interest? One is valuation, one is, where the company is raising funds, and the other one is compliance. And with respect to compliance, you are an expert, correct? You are an expert in drafting those, the minutes of the meeting, all of those things. So in my personal view, I don't think there is a conflict, and I am of the view that you are actually wearing different hats when you are rendering those services. So you are allowed to render those services.
But what is section say, madam? I believe section is clear. I remember initially what they said is that any company secretary rendering secretarial services was the word used, which was later on changed to secretarial auditor. That's what I remember. I don't actually, but I think only company secretary there was an issue in the beginning. Then they said, then they changed it to secretarial auditor.
Shilpa, in my personal view, when you have any benefit of doubt, you should not go with that, because we cannot go to the court. Even
maybe
before the court or before NCLT, whatever the code, okay, it will be given the judgment in different way. Because if you see in IBC code also, whatever it is there in that, okay, once you go to court, okay, the decisions will be changing. When you have a benefit of doubt, better to not include those things in our valuation engagements, because as a valuer, as a company secretary, we ourselves got a doubt, okay, need not to go further.
But Subbarao sir, I'm not telling that it has to be included in the same engagement letter. Can we not have a separate engagement letter for separate
even separate engagement letter also, Kusum, okay, because we have seen IBC cases where the RP appointed his wife as a secretary for providing company secretary activities or CA activities, where there are objections are there from the courts. Even okay, he's not doing, but related party is doing.
No, but is there maybe it is worthwhile to go through the code of conduct or the ethics, and then we understand.
No, that's what I'm saying. As a statutorily, it is not stopping the providing services, but when it goes to any court of law, then the decision may change.
No, I agree with Venkata Subbarao sir, because the thing is, we need to see the substance over form. Whatever the section says, for example, let us say I'm a chartered accountant and I've involved in some specific assignments on forecasting and budgeting, right? And then I become the valuer and I use the DCF basically. So here, that even though I'm not a statutory auditor, I'm not a statutory company secretary, I have been involved in the company's projections, budget, or whatever it is. So when I use a DCF or whatever, as a valuer, obviously there is a conflict in interest, right? So probably
this is a straight case of conflict. This is a straight case of, it is like a person who's bookkeeping, who's also the auditor, which is not allowed. But my question is, when you are actually rendering separate professional services, that is what is my question. I don't think
that is what, see, maybe probably what he says is correct, because substance or form is what we need to see, because we need to see what exactly are involved into it. Maybe it may not be detailed in the sections or anywhere, but probably it is. I completely agree that whenever you are in a doubt, I think it is better to come out of it, or it needs to be disclosed. It depends on how it works.
And Kusum, we are giving a chance to other opposite lawyer. Okay, yes, there is a point. Okay, to raise it, that we need to see.
So, maybe this could be the topic of next webinar. Get some expert on code of conduct, and we can talk about all these things. And for the time being, we can park this here.
Yes.
Okay. So invoicing, payment terms, limitation of liability, agreement asking the client to sign, and you may like to put, if for example, I'm working in Gurgaon, I'm based out of Gurgaon and the client is based out of Bombay. In case of any dispute, I put that Delhi NCR courts will be the jurisdiction, null authority. Signed by myself and accepted by the client. Okay, Mr. Subbarao, I'm sorry I overrun your time by 10 minutes.
No issue, sir. So you can take 5 minutes if you want. You can take 5 more minutes.
No, I'm done. If there is any question, I'm happy to take. Thanks,
Mr. Naveen, in continuation with this engagement, okay, what happens in big firms is they give one assignment of the entire deal to so and so big 4, big 5, big 10, whatever. And then we get to, they say, you raise an invoice on us. The company is not interested in a piecemeal invoicing. In whoever professionals they are engaging in this entire deal. So do you see any problem, as a valuer, can I accept in the engagement letter, I would have mentioned so-and-so is paying the fees to me. So is that okay? No, company is not paying me money. That is the ultimate thing. Do you see any objection here? Am I doing misconduct? Am I doing something wrong, or is it okay?
My personal opinion on this, and what I would do in such case, in the engagement, I will prepare the engagement letter, get it signed from the company. And in this portion invoicing, I will put as requested by the company, invoice will be raised on Big 4, and Big 4 will make my payment.
As requested by company, sir.
Or even if you don't put as requested by the company, you put here that the payment will be made by Big 4. Get it signed from the client.
Sir, in a couple of cases, what I have done, because they are multinationals and they have appointed a law firm in India for the valuation. So we take a letter from the company whether they have appointed that lawyer. And then engagement letter, I have taken it from the lawyer firm that they are appointing us on behalf of the company. So my report is also addressed to the law firm, not to the company directly, especially if they are FEMA cases.
Okay, so
I beg to differ on this.
No, hold on 1 second, Shilpa. See, at the end of the day, whoever gives that, I agree with all these arrangements, but ultimately representation letter has to be given by the company because they are the ones who are responsible.
Perfect. Yes, MRL we normally take it from the company.
Yes, sir.
They address the report to the company, and if you put attention, Mr. Naveen Singal of company and Ms. Shilpa of law firm. I'm just thinking aloud what could be the best solution. If
Sir,
you
there's a simple third scenario what Shilpa is saying. I can just shift it. I'm interested in acquiring a third-party company, some third entity. So I appoint a valuer to value that particular entity for the purpose of my valuation. It's a valuation assignment. So the valuation is done for the third entity. The client is myself, and the valuer is supposed to do from whom he will take MRL. From engagement letter is to address to me, not to a third party, but values of third party. See, I think the essence, someone is the word substance over the form. Here, the substance is someone is to do the valuation assignment, whether he got the delegation authority. So here I am the client, so I have given a right or not. That is not something to be checked out. And most importantly, the payment, like a contract or an agreement, is only valid if there's a consideration. So if I am giving an assignment, then I only have to pay. Third party cannot pay on my behalf.
So my comment would be third party can pay on my behalf if I authorize.
Yeah, authorize, yes, that's okay. Yeah, authorize,
Right.
okay.
Absolutely. And very rightly you pointed out, number of times we get the assignment. For example, today, if somebody comes to you and give the assignment, advise me whether I should buy Unilever share or not. Do the DCF studies and all that. As valuer, nothing stops us from doing that and giving our opinion on the fair value. And then, of course, we will put that he has to take the decision. He has to, take the consequences of decisions and so on. And we do not guarantee that this company will give return or will not give return. The standard disclaimers we will put. But in this case, obviously, the engagement letter will not come from Unilever. The engagement letter will come from the person who is engaging us to do that valuation.
Yeah, just to add here, do we need a board of directors or audit committee signature in this case? You will never get it here.
See, board of directors signature again depend upon the purpose. If the treasury manager is authorized to get these kinds of valuations done by their board or in their scope of authorities. And I think section 247 refers to valuation of own company or investee companies. It does not refer to if you are, for example, as resolution applicant, if you are getting some valuation done. I don't think there is a requirement of any board resolution. So, Brauji, what would be your opinion on this? If a resolution applicant gets valuation done from a valuer, do the resolution applicant need to give a board resolution to the valuer?
So one point in that case, what we are discussing here. So for example, if somebody is really targeting some company to acquire, in that case, there is no as such a regulatory requirement of valuation comes in. Okay.
Absolutely. Absolutely.
So why we want to do the valuation as a registered valuer? We can give the valuation on a presentation like format also in the capacity of a chartered accountant or consultant as well.
Agreed.
No, but
No,
that,
even
so,
if you give it, even if you
if you, go ahead, sir. Go ahead, sir.
sorry, even if we give it as a registered valuer, we can give that valuation. My personal opinion, without any board resolution.
Sir, that is under IBC, and we quote it that valuation is being done as part of the IBC, and our appointment is through RA. There we write it very clearly.
Of course, we have to write, but see in the first line itself, we put that, and we are addressing to the person who is appointing us, and then we are putting the purpose.
Here we mentioned the RP. Here we mentioned that it's addressed to the RP, because ultimately it is RP who is going to put it to COC, and then in turn he'll be answerable to NCLT as well.
Okay, so that is if we are doing valuation of the company under IBC appointed by RP. But if some prospective resolution applicant, he or she can also appoint you to do the valuation. And
yes,
that valuation,
that we do it for SRA. Or sorry, at that juncture it will be RA.
RA, absolutely. And in that case, the report will not go to RP.
Yeah.
Okay.
Very true. And
Okay.
in that, another question was there. I think it was Ganesh sir, he was discussing about M&A deal. And M&A deal, we do it for the buyer. In case we are doing the deal for the buyer, there what we do is the projections will be submitted by the seller. So here, when their projections are being forwarded to us either directly or through the buyer, we write it clearly therein. Is based on the projections shared with us by buyer, whether provided in term by the seller or not, it's immaterial, because we are very clearly pointing it out. Yes, the projections have been provided to us by the buyer, and move on therefrom. Ganesh sir, am I right?
No, I don't remember asking that question, but
essentially,
if
my
you're
apology.
asking,
My apology. In case in that case I missed it. Who the gentleman was?
Yeah, only thing I could say that even if a projections when they are given, normalizing the projections and putting associated risk is something I do, because valuer is supposed to be able to make a judgment on those projections, not accept it what is given directly.
So considering the time, I request to park this question And now I request Mr. Venkata Subbarao Kalwa, our Bangalore Valuers Association President, to go ahead with the valuation report format, preparation and challenges. Over to you, Mr. Subbarao.
Thank you, Shilpa. Thank you, Naveen sir, for setting the session. Okay, it is like valuation basics where we discussed about the revenue projections and the cost of capital, how we are going to consideration, and the appointment of valuer and as well as the engagement letter. And now we will see that, okay, valuation report as valuation report format and what are the contents to be there in a valuation report. And when you are going to prepare the valuation report, what are the challenges you face it. We'll discuss on that. And also this is very, very important. Why? Because when you are submitting one's valuation report, this shows the face of the valuer is report. And as you know that the valuation process begins with the appointment of the registered valuer in case of Companies Act by the Board of Directors or Audit Committee. And we need to have basic documents like the board resolution, engagement letter, and the management representation letter, because where we are going to mention those dates in the valuation report. And again, the process, you have to select a approach, the valuation approach. And if you are selecting more than one approach, then you can give the weightage, like if you have like DCF or net asset value method or market method. And also like you need to discuss with management and the board of directors, and the preparation of your working sheet, like your DCF sheet or other sheets, you have to your working sheets. And again, the reporting, you have to prepare the report and issuance of the report. Issuance, whether you are going to the board or resolution professional, that it matters. And the same process also will continue under IBC, like appointment by the interim resolution professional or resolution professional, and we need to take the appointment letter. And again, we need to give the disclosure, like independence disclosure as per IBC process. Now, new form has been introduced and we have to give the disclosure. And again, here the important thing is the physical inspection. The physical inspection we have to do under IBC because it has been mentioned in the IBC code. It has not been mentioned in the Companies Act or in other standards, whereas it has been mentioned in the physical inspection in the IBC code. That's why it's very, very important. And again, discussion with your management and resolution professional is very, very important to calculate the fair value and liquidation value, and the preparation of your working sheet. The working sheet concludes like as an CRP commencement date, you need to get the financials, and again the trade debtors or whatever other information we need to get, mainly our inventory. And again, preparation of report and issuance of report to the COC or resolution professional. Yes. Here, when we are going to discuss valuation report, we need to see three things mainly: the rules and standards. Like what are the contents to be involved in the valuation report? It says we have companies registered valuers and valuation rules 2017. Rule 18 says valuation report. In the valuation report, it said what are the contents should be involved. And again, same thing, whether if you are following ICI valuation standards, and we have to give, again, they have given the standard 202 reporting, what are the contents the report should contain. And again, if you are following IVS International, like International Valuation Standards, then IVS 103 says about reporting.
IVS 2022 has come, Subbarao, now.
Yes, yeah. Yes, we should see that, and we have to update our valuation report according to these contents based on whether you are following ICI valuation standard and IVS valuation standard. And we will discuss one by one, okay, like for rules and standards, what the content it is saying. See, our main, basically we need to see Rule 18, the company's registered valuers and valuation rules 2017, and the valuer to keep in his report, what are the basic information is the background information of the asset being valued. That means it is like a equity valuation we have to do. And again, we need to mention the purpose of valuation.
Suppose the company is issuing CCPS. Here, what we have to mention?
We have to mention
equity or CCPS.
Yes. The purpose will say that the company is going to issue CCPS and valuation is going to be done for equity shares. The asset being valued is equity, we will put it.
So background information of the asset is equity.
Equity, yes. And the purpose of valuation and appointing authority, whether it's a board or audit committee, we need to mention. These are all rules saying as per what you have to mention. And identity of the valuer, about your information we need to give. And if any other cases, like if you appoint any land and building valuer or plant and machinery valuer, we need to give those information. Those details also we need to give in the valuation report. and disclosure of value interest or conflict, if any. And this is very, very important, because one, if any goes to IBB or any stock exchanges or any NCLT, they will see that the value interest, because the opposite party always will blame us. Okay, this party is already involved with this company and they have tie-up, and okay, they want to give more information on this. That's why we should be very careful in disclosure of value interest. And again, you should put your date of appointment and valuation date, report date. Because see, this valuation date also very, very important. When any report you are submitting for RBI or FEMA purpose, they will see that valuation date and date of report, because the date of report should not be more than 3 months. This is very, very important. And the source of information, like how did you get information from the management and what type of information you got, we need to mention in the valuation report. And procedure adopted in carrying out the valuation. What are the different procedure, whether you have followed DCF and the premise of valuation, and why you are doing this DCF method. If DCF method is not going to be used, then net asset value method, why you have adopted this method, net asset value method or market method. Even if you're not going to use any net asset value method or market value method, we need to mention why you have not adopted. As a valuer, the net asset value method is not correct method and not being valued. Like that, we need to give that explanation also. It is not that only you are going on DCF only and giving the valuation. And the valuation methodology we have to give. And major factor that influenced that valuation. This is very, very important, where in some cases under companies act, if you are going to give like high value, like the share price is 10,000 rupees, 20,000 rupees, then you can give the reason why you are getting the more value. Or in sometimes the value is very less you are getting compared to the projections or revenues or profit, and you need to give that reasons why it is coming very less value. Even in one discussion, practically the company revenue is almost 150 crores and 160 crores, but the profits are very less, and the valuation also is coming to like 20 rupees, 30 rupees, and they have only 10,000 shares they have. If I take 20 rupees into 10,000 shares, okay, the company value is 2 lakh rupees. The enterprise value is coming very, very less. And the reasons also we need to give why it is coming. And also the conclusion, this is very, very important, where the RBI purpose, FEMA purpose or NCLT purpose, they will see more, okay, what is the value you have given. Sometimes, okay, even as a outside party, it is finding difficult, okay, what is the value of the company or the value of the share in all our 20, 30 pages. The conclusion we need to provide, it is the equity share price value or liquidation value or fair value we need to give. And as we again caveats, limitations and disclaimers.
Subbarao, 1 second. In this conclusion, do you say that, do you want to say that only fair value of equity, one equity is to be mentioned, or is it preferred to write enterprise value or equity value? I just want to bring this attention to others also, like how others do. Only the per share value is given, or enterprise value or equity value, which is to be given in conclusion.
See, in my practical experience, we are giving only that equity value only, because already we, in the DCF calculation, we give the enterprise value, equity value we are mentioning. We are giving only the equity value. Maybe if any other people are giving in the conclusion that enterprise value and equity value, we can discuss.
Venkata sir, one question.
Yes, sir.
One question. As you have mentioned that after making this, we have to give our conclusion why the value has increased or decreased. But how can we justify the value is coming because of all this our calculation?
Yes.
So how can we say no, this 20 rupees is not correct, because we are certifying it 20 rupees is the value.
Yeah.
How can we justify it? I mean, I'm not very clear on that.
Correct, sir. Yeah, good question, sir. See, for that reason, what I said is like, okay, the company is doing more investment in CapEx, and also the company is having more debt, and they are doing a lot of research and development activities, and they are going to spend an amount. And okay, these again, they are under very like trademarks and patents they have applied, and it is not approved. See, we have given all these reasons, because when I discuss with the management, the company is doing good and you have a lot of expectations, but valuation is very less. and they have given this information. Sir, we have all these limitations because our product has to be approved by the American, like it is a pharmaceutical company. It has to be approved from US side also. And again, a lot of research and development is going to happen. And same thing we mentioned in the valuation report. Because why I'm telling, even I have one more experience where the valuation report is given for transfer of shares, and the price was only 15 rupees. The opposite party under operation mismanagement, they went to the court because the valuer has done the wrong calculation. It has been like falsificated and 15 rupees only. And even the opposite party got that valuation for 350 rupees. Now they submitted that 350 rupees valuation report also to the court. Now court is checking both the valuation report. It is like 15 rupees valuation report, again same thing, 350 rupees valuation. Okay. Here I can give that one more information is they are saying only the weighted average cost of capital. The one valuer has taken that cost of debt as a weightage for 0, and the cost of equity has come like 16%. The other valuer has taken cost of debt into consideration, that the weighted average cost of capital has come 10%. With that, the valuation price has increased. Then now it is under NCLT.
Sir, I agree, sir. Suppose if I have taken weighted cost of capital and you have considered only the cost of equity,
yes,
but obviously this will be mentioned in the report itself.
Yes, yes.
Right. Suppose there is no weighted what I can say, there is no debt. So even my weighted average cost will be the cost of equity. So how I have to justify my calculation? This I am not able to.
Correct, sir. Yeah, that's what. Okay. Now the two valuers have given two opinions. Now, okay, it is like sub judice and it is going. Okay, like we are giving all information, or okay, we are giving consulting for that. Anyhow, see, these are the small things also will be matter. Yes, sir.
So one small doubt. The other example that you gave, suppose the FDA approval is pending.
Yep.
If the FDA approval comes, the value will be say 200 rupees. If the FDA approval does not come, the value will become 0. Then how do you project? How do you give valuation as of today? Because that future, or supposing the company comes and says that he has applied for some permit. If the permit comes, his value will be X plus something. If the permit doesn't come, it will be X minus something.
Correct.
So how do you justify the projections in that case?
So that's why, sir, the projections also we are saying that, okay, see, these are all the subject to these conditions only. These projections has given like that. Okay, that only we mentioned in the report. Sir, even
so you put a probability, sir, in those projections.
No, sir, that's it. That's in a competition. No? Suppose you apply for a bid, it may come, it may not come. Or suppose you are bidding for a real estate project. Depending on the commercials, it will be approved or not approved. That we don't know. So if it is approved, you will get X plus something. If you don't approve, it will be 0, literally.
Yes. It will not be 0 because you will have domestic sales that will be continued, or if not US, you will import, you will export to other countries. We cannot say 0.
Mr. Ganesh, I have this question. Actually, one of the company, I have seen the valuation report wherein enterprise value is so and so. After enterprise value, they have put the probability factor, the probability of achieving so and so milestone on the basis of which this value was arrived at is so and so. So again, they have reduced that it is only 50% probability. So enterprise value is say 100 crores, and then they have attributed this probability factor, and then they say final value is only 50 crores. So practically, have you also done any point of time like this?
Yeah, I have applied probability weightages for future adjusting, and that's absolutely fair. Only thing is the justification for those probabilities. So the write-up, the stage at which it is in there, what is the past track record of achieving and that kind of stuff. It's end of the day, it's a judgment, right? So where is whether transactions happen with such uncertainties in the market? Yes. If transactions happen with such uncertainties in the market, so someone is actually valuing it at a discount of it, assuming something. So therefore, so for example, recently when someone asked me in IBC cases, so how do you value? I said the cost of funding is essentially a mess funding. Because I said that is the time it takes, it comes to it. So you need to look at that. Transactions do happen with all such uncertainties. Start referring whether you may have data or not. Look at that and do a write-up with some reasoning and rationale. Absolutely valid.
Yeah. Yes.
And one request to all the members, sorry, Subbarao, 1 second. When Subbarao is mentioning here in point D in the presentation, disclosure of value or interest or conflict, if any, suppose you are doing any IVC valuation, at that time you may not be interested, but please be mindful of the future interest which you could be taking in the assets of the company or your relatives, which could be questioned in future point of time. Existing interest while issuing report, no, absolutely fine. But we should also be mindful, we should not acquire any future interest, especially in IVC cases. Others, I don't know, I'm not an expert in that. But then please be mindful of the future interest which you are going to take in that, which is also prohibited as per professional ethics.
See, these are the basic things we need to keep in the valuation report as per Rule 18. And when you are going to follow the ICA, for example, chartered accountants will follow ICA valuation standards. And again, these are the minimum that should contain this valuation report. It is almost the same only as per Rule 18. It is again background information, purpose, and identity of the valuer, same thing. Almost 90% is the same. And the caveat and limitations we need to keep. This is as per your ICA valuation standards, the contents. And again, we have like IVS 103 reporting. Yes, sir. Yeah. We have again IVS, International Valuation Standards reporting 103. Again, the report, again, they say it's the same thing. The approaches, what you are going to do, and the method, what you are going to, and what is the source of information, and assumptions made, we need to have this one. Why I am saying this is again valuation standards also important, where we have seen IBA order. In one of the order, they said the valuer has followed the valuation standard, but as per valuation standard, he has not mentioned the report contents in the valuation report. That's why it is very, very important. What is the valuation standard you are mentioning, whether it is ICISI valuation standard or IVS valuation standard also, we need to see. If you are going to mention IVS valuation standard, one should go through IVS 103 reporting and we have to see whether it is covering or not, all the information. And what I did is like combined of Rule 18 and ICI standards and IVS standards, like the valuer have to keep the basic information in the valuation report. Like background information, again, what is the asset being valued. You can keep this heading also in your valuation report, because instead of finding somewhere or in one line, you can keep the heading and you can prepare your valuation report. And what is the purpose of valuation report? You can keep the heading and identity of the valuer and disclosure. All these things we can mention. These 15 points is very, very important. Okay, without this, any valuation report you cannot issue this with this information. Apart from this, we have again as a general practice, the valuer has to put some more information. Again, company background and objects and introduction. When the company was incorporated, what are the objects of the company? What are the products of the company? This we need to put into the valuation report, because the rules are not saying, the standards are not saying about company background, but one should keep, because any person, any professional going to read your valuation report, they want to see that valuation of the company background also. And again, the appointed date and valuation of currency, because if you are doing any US currency or GBP currency, that details also we need to mention in the valuation report, especially if you are doing any Companies Act valuation of anything. Okay, if they have any foreign currency transaction, we have to put it. And adopted of valuation standards. In the Rule 18 or standards, it is not saying, but as a general practice, we need to keep what are the standards you are adopting, whether IVS standards you are adopting or ICI standards you are adopting. And again, we need to give the definition of fair value and liquidation value under IPC. What is the fair value? It is the realizable value from the selling of the assets, or liquidation value. Those definitions also we need to put in the valuation report. Then only the judges will be understanding what is the value we have given and what is the value it is defined in the under IBC code. And again, the CRP and liquidation commencement date also we need to provide. And when this resolution professional appointed, in which COC meeting, those things also we can give information. And again, the registration number and COP number of the valuer. It is very, very important now under Companies Act, like PS3 has been reduced, where they are asking that the valuer UDN and again the valuer membership number. Maybe you can mention your CMM membership number or ICISI membership or CMA membership number also. You need to mention. But in case of a MBA, then I don't know what is the number they can give. But when you're filling PSC3, they should know, that company should know your membership number. Those details also we need to put in the valuation report. And the management and resolution professional representation letter, you need to specify that, okay, like you got a MRL from the management. And also industry analysis and outlook. When you are doing any pharmaceutical company, then you can see that next 5 years, 6 years, what is the industry analysis. For this, we have a lot of websites. Even you can check in Google how is going to be the pharmaceutical industry. There we can take some points and we can keep in our valuation report, and you can give below source also from where you got it. Whether it is from CNBC or Bloomberg, we can put it all those information. If you keep all these things, okay, the value of your report will go. Because even if you give more value, then you have these predictions, or you have the industry analysis, it will support you, like based on this industry analysis and outlook, like we have given these projections or we approved these projections. And again, the calculations, your working sheet, cash flow, cost of capital, growth rate, beta, all these things we should mention in the report. Yes, there are different views. We need not to mention in the valuation report because it is a very confidential information. But in a lot of other discussions at the end, it has been discussed that, okay, better to mention all these working sheets in the report. Why? Because we have a practical case in our NCLT Bangalore. The valuer has given only that swap ratio between two companies. And the valuer has not given any information. What is the value of A company? What is the value of B company? How it has been arrived? Then the official liquidator questioned that one. It is not NCLT. The official liquidator report, they question, how did you arrive this one? They don't have any answer. They sent again back. Then again, they have to put it all those things, information. And again, the valuer has given new valuation report, and it has been submitted to again ROC, RD, or NCLT. Because maybe, yes, Shilpa.
Actually, you're just mentioning calculations,
yes,
like growth rate and beta. Is it just okay to just mention, or is it required for justification also?
It is for justification also. Yeah, it is
not
required.
Every valuer is specifically mentioning. If some beta is taken, why so and so beta is taken?
Yes.
I don't think every valuer is mentioning.
Yes, correct. See, how they got beta also they are not mentioning, or some valuation report they are not mentioning beta also. What is whether 1 or 1.5? At least you can mention that 1 or 1.5. Even if you don't mention, okay, like how did you get it? If you mention how did you get that beta also, that is good. And one more thing is like physical verification is very, very important in IBC valuation, where in few cases, even IBBI also suspended for 6 months, where the valuer has not done the physical verification. And you have to do the physical verification, and we have to take the photos, and you have to keep in the valuation report.
So for SFA, what photo we will take? We are not valuing the plant, machine, and inventory or land. As in SFA,
sir, at least you can visit that register office of the company, or with resolution professional. If the register office says we have to visit, and even in a few cases we have visited where along with the land and building and plant and machinery valuers, and we have taken photos there.
So sir, whether can we take the inventory valuation in our SFA scope?
Yes, sir. That I will come out, sir. That is again a big discussion on that. It is all depending upon that how the RP is appointing you, whether he is considering that inventory valuation as per your scope, or it is not that.
So, sir, even the company, just 1 minute, sir. Even the company is located is outside the state of the SFA valuer, then it's also compulsory as per IBBI to visit the.
When you are doing inventory valuation.
No. Apart from inventory, local IBC valuation.
Yes, sir. Yes, sir. It has to be, because in IBC they have not mentioned, okay, only plant and machinery or land and building valuer has to visit physical inspection. They stated that, okay, the valuer must visit that physical inspection should be there. There no exemption to SFA valuer.
Under which regulation under IBC, sir? I doubt it.
Yeah, that I will send you, sir. We have that.
No issue.
Yes.
Thank you, sir.
Yeah. And
even you have not mentioned here balance sheet and PL projections. Is Is it required, not required? Cash flow, automatically it will come, as you have mentioned in
Yes.
point 24.
Yes.
Balance sheet and PL projections.
That we need to mention, definitely.
Balance sheet projections, many times it is not made also, no? It is not mandatory.
It's not mandatory, but if you have prepared and you can put it that. Because we are putting that even revenue projections as well as balance sheet projections. And photos, because it's even in physical verification, because some people, okay, some valuers feel that, okay, they are giving very less price where we can visit, but we have to count those things, physical verification. And we have been doing last 4 years physical verification of all IBBI valuations, especially. Yes. And again, annexures, we need to put it like where you've taken that expert reports or any land and building value report or plant and machinery report, we need to attach, because it will give that more beneficial to the authorities as well as to the management. We need to attach that annexures, not only mentioning that valuation given by the land and building valuer, and a disclaimer about subsequent facts after valuation date. This also we have to specifically mention. See, this is 16 to 28, all these points are not mentioned anywhere in the rules or in the standards, but as a practice and as a courts will see or officials will see, we need to give all these details, because this is the very, very important information. Yes. Again, what are the challenges when you are doing valuation report? Already we have seen that the revenues projections which companies giving, whether how you are going to validate, how you are going to justify whether these companies will meet or not, because we have seen in when we discuss with income tax authorities, they will say that 99% companies will not achieve these projections what they have given. Even you can see that whatever the valuations you have given last 3 years, and you can go and check their balance sheet whether this company has achieved or not. Even we have verified few companies, like 95% companies are not achieved those projections where we have given the valuation report in 2020 or 19. That is one thing we need to see the revenue projections carefully. And the selection of a company and resolution professional, why I am mentioning challenges, some resolution professionals will not give information properly and they will expect from you, the valuer, okay, to do everything. Because I have a live case where the resolution professional from Delhi, he appointed a valuer in Bangalore, land and building valuer, and that resolution professional is sitting in Delhi and he is saying, you go and visit all locations, the land and building locations, you give me the report. Otherwise, I will report to you IBBI on you. You are not doing your activities properly. You are asking me to come or you are asking to help and all they're saying. And the valuer again, okay, because of threaten from the resolution professional, he visited that. Because otherwise he's saying that, okay, I will report to IBBI. That's why selection of resolution professionals is important. And some resolution professional won't give any data and they want to expect everything from you. And last minute, they will make you hurry that, okay, you provide the report, we got the resolution plan and we need to submit the COC. And even if you give the value, and again, they will influence you to reduce the value or increase the value. And again, when you are going to be appointed any resolution IBC cases, you need to see the second valuer also. Because in a lot of cases like IBC, they got notices where 3 valuers are appointed. If 2 valuers appointed and they are given the value is different, more than 20% or 50% different, and the resolution professional appointed third valuer, in those cases also IBBI get a doubt. Why the first 2 valuers has given data, okay, very much difference, and third valuer why is appointed? Because they'll take all these cases by the IBBI. And again, the signed management representation letter, we need to take it even in this Companies Act cases also. Sometimes the board will say that, or management will say that, why should we give the representation letter? And we need to insist that, okay, we need to get that. And again, the stock valuation, when you are going to take any stock value or any IBC valuation, you have to discuss with your resolution professional whether the valuation of inventory is part of SFA or part of plant and machinery. Then only you can take the assignment based on discussion. because they don't identify, okay, because of the in rush to get that assignment, we will accept. Then again, the plant and machinery person will say that, okay, you have given very less quote for us and we don't do that. It is not part of, we do only plant and machinery fixed to the wall or earth. And when you're going to give any quote for any companies for IBC, especially the investments made in unlisted companies or investments in foreign companies also we need to see, because in one of the IBA order, the valuer has not done that unlisted companies investment valuation, he has not taken into consideration and they suspended for 6 months.
Subbarao, 1 second. Book value was also not considered, or it was ignored, or proper DCF, or what was the query there? Book
See,
value was also not considered.
It's not considered, it has given 0.
He has missed it.
Missed it, yes. Okay, and again the balances available with especially GST or income tax. Okay, this also you have to take, you have to give proper information that when you are giving value 0, why are you giving the value 0 has to be specified. And again, we have to see the valuation of intangible assets, very, very important when you are doing especially IBC valuation, whether the company is having any brand or trademark or any other patents, that also we need to take into consideration. Because all these considerations, okay, they don't give in advance all this information. When it is goes to COC or when it goes to bank, they will verify your valuation report and they will ask all this information. And then in turn, resolution professional will ask you again why you have not given all those things. Then we cannot say that, okay, resolution professional has not given information. As a valuer, we need to ask all those things. And fees, as you know that again, it is all depending upon company to company, and urgency at last minute issue of a report. A lot of resolution professional or a lot of companies will make you urgency at last minute to issue the report. That also we need to take care that, okay, how we are going to solve this. These are the basic important things when you are issuing the report. And also I will show you few things, okay, like recent orders. These are the recent IBA order suspended the valuers. Okay, in most of the case they suspended plant and machinery valuers only, not SFA valuer or land and building valuer. That is one thing everybody should know, that because in plant and machinery valuation, okay, that what are the standards of preparing the reports are very less. Whether their ignorance or they don't have that much experience in preparing valuation report, and the IBA has seen that and they suspended in most of the cases 6 months these valuers. Since we don't have time, okay, I will discuss, okay, in this case where they suspended our registered valuer, the estimation of value of trade receivables. In this case, that estimation has been given 0 value. That's why, okay, the IBA said, why not it is the 20%, 30% not valued your trade receivables. And again, they also questioned with respect to short-term loans and advances. And again, valuation of inventories. And again, they mentioned valuation of standards are approached. They have not, he has not given in the valuation report. For this also they questioned. When any matter goes to before NCLT or before IBBI, they will see each and everything. They will go as per rules, they will go as per standards, and they will see your report whether you have mentioned or not. Even you might have discussed with your resolution professional or with the management, but if you don't mention in the valuation report, then it will be a task.
Sir, my humble request is that as the valuation is now in the nascent state, serious management should not be given by the IBBI, and RVO has the role to play to safeguard the interest of the RVs also. They are taking a huge amount of money from the RVs, but they are not taking anything interest of the RVs. That is very, very pathetic, sir.
Yeah. So this is not only in the valuation, or same thing in IBBA also, in insolvency professional cases also happening, and IBBA is suspending a lot of insolvency professional, and even why the IPAs are not coming and why they are not issuing notices. Yes, the IPS are taking or RVOs are taking lenient views because even they don't, okay, if they punish, RVO is going to punish, then they don't get any members. Even they have their own challenges to suspend members or to issue notices, but IBBI will not think like that. Because we need to see the challenges faced by IPS and RVOs also.
Considering the time, we would like to wind up the session.
Anyway, Subbarao, one last question.
Yes, sir.
Please go ahead.
Yes, sir.
See, suppose a private limited company is starting today. They don't have any with a two promoters.
Yes.
Now they didn't form their how to do their business in future and all that, but they need to issue shares to persons who are not the shareholders as on today.
Yes.
Not the promoters. Should they again go for a valuation? Then in that case, how did you valuation? Because the company has not formulated any way forward or any such thing. They're still in a nascent stage only. How do you do that? Is it required by valuation? Otherwise,
Sir, it is required. Valuation is definitely required. But maybe your question is like, okay, how can we give the projections? And even if we give the projection, that will be justifiable or not in the valuation report.
You're right, because the company has not formed how to do business in way forward. That means they didn't make an application or they didn't get any order, nothing as of today. Everything is in plan only. Suppose even if I start a software company, you can't say that objective is to become like Infosys Wipro, but then as of today, I don't have any contract with me. We are still planning out how to get a order or something.
Sir, for that, for those cases, what we can do, sir, we can give that the directors or management experience, whatever they have some 20-30 years of experience, we can put it more in the valuation report. And with this expert, like whatever experience they got, and we can get the revenues in future. See, for example, like
but those numbers will be totally arbitrary.
Yes, obviously, sir. Sir, even
totally arbitrary. No, see, if you have a contract on hand, you can say that okay, this contract will give me 10% return, 20% return, something projections you will do. If there's no contract, nothing, they're still in the process of applying for that business, this business, and all that.
Yes.
And then what you're talking of is only say company which is old, 3 years, 4 years, 2 years, 3 years old only, or 1 year old only. And
sir, even for experience or 4 years in corporate, 10 years in corporate company only also, it is like as whatever the projection they have given, it is arbitrary only. It is not that mandate or sure that okay, they will achieve those projections.
Then based on those projections, if you give any valuation, it will so I don't know. How do
Can I answer that, sir? Mr. Devarkonda, sir, can I answer that?
Sir, 1 minute, sir. I want to extend this question. Like one of the point what the speaker is trying to say is the experience. But right now, I have a similar situation where is, very young professionals are coming. They may or may not be experienced. So I'm also finding difficulty in that situation wherein, the promoter, there is no prior success ratio, there is no experience, but they are very enthusiastic young professionals. Yes, sir, Ganesh, sir, please.
Yes.
Yeah, one of, sorry, sir. Subbarao, sir, go ahead, sir, please.
Yeah. See, Shilpa,
I got a query, Mr. Subbarao. Say, in case of IBC valuation, say, how do we value the receivables, deposits, or creditors, etc.? Debtors. Say, can we rely on the statement of the insolvency professional?
Yeah. Sir, especially for trade receivables, we need to take care of a lot. Okay, we need to discuss with the resolution professional, with the management, and we need to see the last 3 years their financials. And again, we need to discuss with the resolution professional whether he has sent any notices to the trade debtors, and he got any confirmation, balance confirmation from them or not. All those things we have to put it. The main basic information is the balance confirmation itself is they can't get from the trade debtors where they will get the money.
Yes.
Okay.
In some cases.
Yeah, we have to prepare all this as an Excel sheet for each and every debtor. Maybe they have 30, 40 debtors, whatever it is. For each and everything we have to discuss. It is not that okay, one go with trade debtors 2 crores rupees putting zero value. I will suggest that okay, each and every debtor you take it, and each and every debtor when they have sent information, whether they have sent any balance confirmation received or not, then you can give the value.
So if nothing is available, no balance confirmation, even no communication with the debtors, then we should take zero value, no?
Yes, why not? Yes, zero you can give it. Sir,
Yes,
when you give whole information without giving all background, if you give the zero value or a high value, that is the matter. Because if you see trade debtors also, even some companies are in liquidation, some companies closed, some companies even they don't identify where is the address also. All those information we need to give in the valuation report.
State the facts.
Sir, in cases where confirmation has not come from the debtors,
yes,
there is an option with the RP or the company to go for legal cases. So
correct.
how can we take value 0 in that case?
Yes, sir. So no, again, see, for resolution applicant also we need to see that, okay, when they are preparing the plan and going to give, how they will look out these trade debtors. Even they will be having the same thing in mind, okay, whether they are going to get or not. Yes, if it is again before the court, you can give the fair value, and liquidation value you can give 0, because again the resolution professional liquidator has to close the company. Even they can't continue for 4 years, 5 years.
So even closing,
Sir,
after closing also the cases go on. So there are assets called not readily
yeah.
realizable assets.
Yes.
So the cases go on. So you cannot take value 0 even if
Zero,
the
yes,
debtor is
sir.
saying
You
no.
cannot take value 0 at the same time. We cannot take 20%, 40% also, and there is no justification for 20%. Even in some cases, order said why value has not taken 20%. Why 20%? Why not 40%?
No, at least some value should be given based on the valuer's judgment in that case, rather than taking 0.
But
So
how
my
do we
next
know
question is on.
whether how much can be realized in
So,
future?
Yeah,
so can I
that is
answer that,
important.
sir?
Sir, in all
Can I answer?
IBC cases, how much the insolvency professional realized? Okay, in my own IBC cases, okay, we have not got single pay from any trade receivables.
So can I answer that, sir?
Yes, sir.
So two parts on the question. One is on the trade receivables. One is on the earlier projections of Mr. Devarakonda and Shilpa's. My understanding and my little input. As regards trade receivables is concerned, first is whether they are individuals or whether they are limited companies are very important to check. If there are individuals, then it's almost difficult to get the money back unless they're of huge value and you have some. First is documentation. If you have documentation, you can go after them to legal route. So what I typically do is the cost of legal versus the amount to be recovered. If the amount to be recovered is much smaller than the cost of legal that I'm going to incur, I put the value as 0. As far as limited companies are concerned, again, the same approach. Only difference here is what I do is the Limitation Act. If the 3 years have crossed or number of years has crossed, which is beyond limitation period, and I don't have a legal remedy, and the other person is not responding, I put the value as 0. If I have a legal remedy and the cost of legal is lesser than the cost of recoverable value with my documentation in hand, then I put a value. So this is largely the two ways I try to differ every time when I put a value for the SFA trade receivables. So now when someone might say whether you'll put 20% or 30% or 40%, the simple thumb rules are there. Like it's a typical ARC or NRRA. You typically tend to value at 20-25% of the recoverable value whenever ARC is purchasing from the institutions, if there are documentations in hand and if it is within the limitation period. So that's why to that extent that supports. And that number is nothing wrong about it. Typically a legal period takes 3 years time frame, and you discount at a return of 24% return, you tend to get to a 25% recoverable value. That's the thumb rule. And that's where plus or minus depending on the documentation. So you need to ask a lot more documentation, especially if you're putting a value over there. As regards to Mr. Devarakonda's question regarding absolutely new entity, no one is there and all. I have a completely, why should there always be a positive value for any company or any individuals? So when I look at it, would I pay a little premium to anyone just because someone came to me and said that, okay, I'm interested. So to start something, give me money. Why would I give a premium? So if there is a substance in hand, so someone said that if there's an experience, if there's some capability, if their idea is good, if there's something, or the person who have come in, they should show that they have approached with this idea to some people, and there is some written communication that someone is interested. There is some uniqueness in their product, and they showcase some presentation. All those will determine whether I'm going to give a premium like any other startup part of it. Otherwise, it's an absolute face value and no premium required to be given. So it requires a lot more detailing in terms of these facts than just putting some projections. The projections are of hardly any value in this case.
Sir, to answer again, one small query there. That's what the promoter also is saying that I don't want any premium or anything, then where is, I don't even require a valuation report. That was his doubt.
That's a different story. Yeah,
No,
if it's
so
a
why
par
should
value, why will
when
they
he knows that his company is not worth even 10 rupees, okay, because of Companies Act, he can't issue it less than 10 rupees. But then he's questioning, why should I get a valuation report at all?
Yeah, not required.
There's nothing for me to project or showcase.
Absolutely not required. You're right, bang on. So undoubtedly. So that's again, whether you require a valuation report or not is as per the law. If it's not required, it's not required.
No, but
So
is it required? Is it required? That's what my question was.
No, it's only at face value. If you're issuing, I don't think you require any valuation report. Someone can, I'm not too specialist, but to my knowledge.
But you're issuing to persons other than the existing shareholders.
No, it's at face value, right?
Face value.
No. Other than shareholders. Okay. You're issuing the third party. Okay. That's Mr. Subbarao can answer better. That's legality.
Regarding this question on
Consideration of time, I
inventory,
was thinking if we could announce closure of the session.
can I ask one question, last question on
Sir,
inventory part?
we will discuss offline, sir, because a lot of things are there.
Right.
We will discuss offline.
Sure. Thank you. Yeah.
Mr. Alok, please, get in touch with the speaker.
Sure. Thank you.
Thanks everyone for your active participation. I request Mr. Sagar Shah to convey a vote of thanks on behalf of Bangalore Valuers Association for today's speakers. Mr. Sagar, you are on mute.
Am I audible now?
Yes.
Yeah. So thank you, BVA, for bringing this topic, because the topic was the way we are getting the IBC order from last couple of days, continuously day by day. So the topic was really the need of the hour, and the speakers also, which we have got on the floor, Mr. Naveen ji and Mr. Venkata ji. So basically, those are the expert of the field and who are bringing a lot of experiences. It is really enriching for all of the BVA community to get the speaker like them. And the presentation of Mr. Naveen ji and Mr. Venkata ji was really informative, engaging, and incredibly useful. We all hope that this will help us in our day-to-day life, that how we should really care about the small things in the DCF valuation. While we all know about the majority of how the practical methods work, but the way Naveen ji and Mr. Venkata ji has given the insight on which all things we should take care while preparing the valuation report, while preparing the working, is really insightful. And we hope that it will help the entire community to bring us forward. Thank you so much once again.
Yeah, thank you, Mr. Sagar, for the vote of thanks. I hope all of you are aware we have this physical session planned on May 13, 2023 at Bangalore premises. So please register yourself for the event. That's going to be a wonderful session, I promise. Thanks, everyone. Bye for now. Have a happy weekend.
And a happy Ramjan also.
Yes, Eid Mubarak.